Do you want to quit your job with 5 rental properties? Do you want financial freedom with $2,500 in passive income per month? Do you want to know why real estate has an edge over stocks? The answer is simple. Understand the 5 profit sources of real estate. Master the leverage of bank financing. Why does it work? This slide explains it all. Look at the asset allocation of the wealthy. Studies vary, but real estate is one of the main pillars in many cases. Why is real estate chosen? The answer: real estate has 5 profit sources. Rental income, property appreciation, tax benefits from depreciation, inflation hedge, and leverage amplification. Stock returns are mainly dividends and price changes. Behind them are profit growth and valuation multiple changes. This is the strategy the wealthy have learned over decades. This isn't a hypothesis. This is a data-proven pattern. And this is achievable. Buy 5 properties. Generate $500 monthly cash flow from each property. With $2,500 in passive income per month, you can quit your job. Today, I'll show you the financial data. Now, let's look at the 5 profit sources of real estate. First profit source: rental income. This generates monthly cash flow. Your tenants pay your mortgage. Second profit source: property appreciation. While it rises in the long term in many cases, it can fall for several years during periods like interest rate hikes. It's also important to look at real terms, meaning after inflation adjustment. Third profit source: tax benefits from depreciation. In the U.S., the building portion of residential rentals can be depreciated over 27.5 years as a general rule. However, land cannot be depreciated. Commercial properties are 39 years, among other conditions, and there may be depreciation recapture tax upon sale. The U.S. is 27.5 years, but Japan ranges from 22 to 47 years depending on structure. Strategy changes with each country's tax system. Fourth profit source: inflation hedge. In the long term, rents tend to track inflation, but in the short term there are gaps due to supply/demand and regulations. Loans also vary in inflation resistance depending on whether they're fixed or variable, so evaluate based on contract terms. Fifth profit source: leverage. With bank financing, you can buy large assets with little equity. This amplifies returns. Here, let's see the magic of bank financing. You're buying a $100,000 rental property. You put up $20,000, just 20%. The remaining $80,000 is lent by the bank. Annual rental income is $12,000. Operating expenses are $7,000. This includes taxes, insurance, repairs, management, vacancy allowance, all of it. Up to this point, NOI, or net operating income before loan repayment, is $5,000. The amount left after deducting mortgage payments from here is your remaining cash flow. Understanding this structure is critical. Stocks have margin trading and securities-backed loans, but they differ from real estate loans in that price drops easily trigger margin calls. This is real estate's unique magic. Build your wealth with other people's money. However, there are cautions. From 2024 to 2025, interest rates are high and loan approvals are strict. For yield calculations, factor in assumed interest rates, DSCR, insurance premium increases, and judge whether cash flow remains. Interest rate levels dramatically change your remaining cash flow. With current high interest rates, you need to carefully determine whether positive leverage, where property yield exceeds borrowing costs, is working. Now, let's think in concrete numbers. Generate $500 monthly cash flow from one property. Let's define this as conservative remaining cash flow after factoring in vacancy, repairs, and CapEx, or capital expenditure reserves. Without definition, numbers fluctuate. In real estate practice, it's standard to factor in vacancy rates, repair costs, and reserves for roof and plumbing. Own 5 of these properties. $2,500 in passive income per month. That's $30,000 annually. Whether you can live on $30,000 annually varies greatly by country, city, and household composition. Calculate based on your area's cost of living, rent, insurance, and taxes to make the judgment. You can live without working. This is financial freedom. How much equity capital is needed? $20,000 per property. $100,000 for 5 properties. Saving $100,000 isn't easy, but it's not impossible either. Save $1,000 per month, and you'll achieve it in just over 8 years. And that $100,000 will change your life. Let's compare real estate and stocks with financial data. Long-term stock returns vary by market, period, and currency. For example, U.S. stock long-term nominal returns are generally high level, but annual rates cannot be fixed uniformly. Leverage is possible with securities-backed loans, but price drops easily trigger margin calls. On the other hand, real estate. Return on equity appears high due to leverage. However, distribution is large due to interest rates, vacancy, repairs, taxes, etc. It varies greatly by region and interest rate environment. Stocks have high liquidity. You can sell immediately, but real estate emphasizes cash flow. Monthly income comes in. This is the path to financial freedom. It's not about which is superior. It's about which fits your goals. And it's important to compare with aligned assumptions. So, how do you acquire 5 properties? There are 5 steps. Step 1. Research the market. Find areas with high rental demand. Regions with low vacancy rates and growth potential. Step 2. Prepare $20,000 in equity capital. This is the down payment for your first property. Save $1,000 per month, and you'll achieve it in about 2 years. Step 3. Analyze properties. There's the 1% rule, a guideline where rent is 1% or more of property price. Aim for the 1% rule, once considered the golden standard, but in current markets, 0.7 to 0.8% may be passing grades. However, keep this as an initial screening guideline. Make final decisions based on NOI, cash flow after loan payments, DSCR, and actual numbers including repairs, vacancy, taxes, and insurance. Step 4. Secure financing. Raise your credit score. Prepare the down payment. Prove repayment ability. Step 5. Build a management system. Self-manage or delegate to a management company. When delegating to a management company, property management fees or PM fees are typically 8 to 10% of rent. This cost also becomes a major factor squeezing cash flow. These 5 steps are your real estate investment blueprint. Now, let's organize today's key points. Here's today's summary. First, real estate has 5 profit sources: rental income, property appreciation, tax benefits from depreciation, inflation hedge, and leverage amplification. Stock returns are mainly dividends and price changes, with profit growth and valuation multiple changes behind them. This is why real estate is chosen by many wealthy individuals. Second, leverage amplifies returns. However, the effect varies greatly with interest rate environment. In high interest rate environments like now, you need to carefully determine whether positive leverage, where property yield exceeds borrowing costs, is working. Appropriate property selection and interest rate conditions are keys to success. Third, cash flow strategy realizes financial freedom. $500 in monthly cash flow. This is conservative remaining cash flow after factoring in vacancy, repairs, and CapEx reserves. Own 5 of these properties. $2,500 in passive income per month. This frees you from your job. Which market will you search for properties in? Share your strategy in the comments. Your goals, your questions, your success stories. Everything becomes this community's wisdom. Thanks for investing your time with me today. This channel provides concrete strategies for real estate investment, stock investment, and financial freedom, explained with numbers. You can achieve financial freedom too. If you want to gain that conviction, subscribe to the channel. Turn on notifications too. See you in the next one.